Hi, good evening, everybody. So excited to be back with another Endowus live webinar. This
Everybody,
one,
so excited
sorry,
be back with another Endowus live webinar.
Okay, I've got my YouTube on.
Everybody,
An accident. Okay, so yeah, let's start this again. Welcome everybody to Endowus live webinar, where we will be reviewing our 2Q 2021 performance and share several market insights. Really excited to have with me my partner in crime, Wei Mei, who is our Chief Advisory Officer. Wei Mei, say hi.
Hi, everyone. Good evening. Great pleasure to be speaking to all of you again today.
Wonderful. So just very quickly, our disclaimer: as an MAS licensed financial advisor, as well as a financial institution, we do need to share these disclaimers with you. And a quick plug: your familiar face is at the bottom right, Wei Mei, who's going to be leading the session next week. So next Wednesday, 4th of August, same time, 7 p.m. And as most of you know, we separate these Endowus live webinars, which is much more content about Endowus or about Endowus partners like bloggers, financial bloggers. It's much more personal finance friendly. So it's a bit more casual. And then we have the Endowus Access live webinars. So Endowus Access is webinars that we hold together with our partner fund management companies primarily, and other experts in the field, where we provide access to exclusive content. So Wei Mei will be leading the session next week together with 3 amazing speakers. And it will be on the subject of real estate, which is the most popular topic here in Singapore, as we all know. The title is Diversifying Real Estate Investments Beyond SGX and S-REITs. And Wei Mei, do you want to share a little bit about next week's session and who's joining us?
Next week, we have the privilege of 3 different portfolio managers. And I think this is going to be an all-star cast. It's the first time that we're having our all-female panel. So I'm really excited about it. I will have Xing Yan joining us from Janus Henderson, Chiu Ting from BlackRock, and also Su Fang from UOB Asset Management. So in my view, they are the best portfolio managers that we have in this region. And they're going to talk more about the trends as well as the opportunity set in both listed real estate as well as on REITs, both in Asia and also globally.
Yeah, so that's really important, Asia and globally. So I think oftentimes Singapore-based investors, have an overexposure to Singapore real estate. We also have the physical real estate, and then we also put all of our money into Singapore REITs, for example. So really being diversified is really important, and these fund managers that Wei Mei will be hosting are investors into global real estate and regional real estate as well as Singapore. So that's really interesting, and we have 3 amazing partners joining us next week. So please join us, as Wei Mei highlighted, 4 amazing women who will be speaking to us next week. So please join us, sign up. Quick housekeeping on Slido. So this is the Slido poll number 726397. The link is actually below on the YouTube. There's several other really useful YouTube links. You can sign up with an Endowus.com representative, MAS licensed representative, to get a 15-minute session to discuss. If you have any other questions, you can reach out to support@endowus.com. And if you have any specific questions on today's session, it will be on Slido. So please take note of this. Go to the Slido poll. Wei Mei and I, and Sheng Shi, who's online as well, our personal finance lead, as always, a stalwart of these events. He's actually tracking the questions as well and working with us. So please leave some questions on there. We already have several on it, quite a few actually. We'll get to it. Okay, guys. Oops, I think I pressed the... Yep, I think something happened. Sorry, give me one sec. I pressed the Slido link in the slide, and then it just popped up as a separate. So I think this is supposed to be, yeah, there you go. Whoops. Okay. So just going back to the slides and jumping right into it. So just a couple of slides about Endowus. I think a lot of people don't realize that Endowus is many things to many people. We have the core advice portfolios that we will talk about we'll talk about today most of the time, especially because we're reviewing the performance over the last quarter and year to date. So we'll talk about that. But in general, whether it's in our advice portfolios or whether you're buying a single fund on FundSmart or creating a portfolio in FundSmart, if you invest through Endowus, it really is one of the most efficient and cheapest ways to invest in mutual funds, unit trusts here in Singapore. And just wanted to explain a little bit of detail because many people, confuse this or come back to us and ask these questions. So in many cases, most investors access these unit trusts through banks like DBS, UOB, OCBC, or they go through brokers. And brokers can be UOB Kay Hian, it could be Philip, etc. But also they go through the fund platforms like iFast Fund Supermart, Dollardex, and Poems, for example. So there's three main but multiple ways in which you can buy unit trusts. All of them have very expensive costs embedded into it. Sometimes it's transparent, like the upfront sales charge that the banks charge you. Even private banks charge you these things. So it's not about having a little amount of money or a lot of money. Both groups of people will have to pay these fees, but they have to pay sales charges. Sometimes it's 0.5%, sometimes it's 1.5%, and up to 2% that I've seen recently for mutual funds. But those are for the retail share class mostly. So apart from the sales charge, you actually pay a much higher fee in terms of the ongoing annual management fee. So the management fee is the fee that's paid to the fund manager. But on top of it, you layer on the total expenses of running that fund. And so if you combine the management fee, the management cost with the managing of the fund cost, that's the total expense ratio. And that is the total cost that an individual pays on the fund. And that is taken out of the NAV of the fund, so you don't actually see it. The problem is the retail funds with the high TERs, the total expense ratios, embed in it another layer of fees, which is the trailer fees or retrocession fees, which is the commissions that they pay to the distributor. And many people think that iFast Fund Supermart or Dollardex, all these guys are low cost, but in fact, this is how they make money, the retrocession trailer fees. And that could be as high as 0.5 to 1%, sometimes as high as 1.5% of the total fees. So retail share class of something like a PIMCO income fund, which is one of the most popular fixed income funds, at the retail share class, the TER is 1.45%. But there is a lower cost share class, which is called the institutional share class or the clean share class. And in this case, PIMCO has an institutional share class that is 0.55%. So if you look at the difference, it's a massive difference, 0.9%. It's a fraction of the cost of a retail fund. Now, some fund managers don't have these institutional or clean share classes that we can access, taking out the trailer fees. So what we've done is introduce this new concept called 100% trailer fee rebates. And the trailer fee rebates for these funds are as much as 50% of the management fee or 1/3 to 1/2 of the total expense ratio. So on the Endowus platform, it's really important to understand what we publish as the total expense ratio is often the institutional TER, but also the retail TER has a trailer fee rebate. So the net TER that we use is much lower than every other platform that exists in Singapore. So iFast Fund Supermart, Dollardex, and Poems will receive this 0.37% extra fees, but because we pay that 100% back to clients, it becomes a net TER of 0.5%. So regardless of what platforms you're using, whether it's a bank or a broker, single funds or a model portfolio created on the FundSmart is going to be cheaper. And so this is And on top of that, Fund Supermart actually has as a platform fee. So this is 0.2% for a fixed income fund. But actually, if you buy an equity fund, it's as high as 0.35%. So Endowus does charge an access fee or platform fee. So I've put the highest number here, 0.6%. If you're investing through your CPF or your SRS, then it's actually 0.4%. So much, much lower. So this should be not 1.15%, but 0.95%. If you actually have more than $1 million in our account, then it goes down to below 35 basis points or 50 basis points if it's above 200,000. And if you have more than 5 million, then obviously it goes down to as low as 25 basis points. So this fee, the total cost of investing in this PIMCO income fund or any other fund, but this one particularly would go down as low as 0.8%. Compare that to the 1.45% all the way up to 3% for Standard Chartered. So there are a lot of fees that are embedded into funds. And, when you create portfolios with multiple of these funds, then you're paying the sales charges with the banks. And for the fund platforms and brokers, you're actually paying a fund level fee that starts at a much higher level. And stays there every single year that you're paying to these guys. And that's how they make money. And Endowus is going to be cheaper than even Poems or Dollardex or Fund Supermart, than on pretty much like 80% of the funds that are onboarded in the Endowus Fund Smart platform. So please check out the investment list, go into the details, do your due diligence. Costs compound tremendously over time. So it's really important for everybody to lower cost at every opportunity. Now we'll move on to what's today's main topic, which is the second quarter review. Emerging market global equities have continued to rally, as most people have know. We had a bit of a wobble, in the end of first quarter, where especially emerging markets rallied very strongly and then pulled back. But actually, the global markets have actually had a very steady rally, and so the equities market has done really well. The fixed income market, which Wei Mei will touch upon in more detail later, and I'll cover the equities piece, has been a little bit more volatile. But that volatility obviously is not the same level of volatility as equities as an asset class. But having said that, with rising interest rates and concerns about inflation, we've had a bit of a pullback in the mark-to-market returns of fixed income. But after that weakness in the first quarter, we've seen a steady rebound in the second quarter. So fixed income numbers are all positive as well, which I'll go into. And we show this kilt chart every time, and so maybe it gets a bit boring. But Wei Mei and the team has updated the slide to second quarter. So at least we have the quarterly stuff in there, so it's a bit more interesting, and the year to date. And as you can see, the second quarter numbers for EMX of Asia, so it's outside of Asia, so mostly Latin America and the Middle East and Africa, etc., EMEA as we call it, have done really well in the second quarter, and as a result in year to date. So obviously we're only 2 quarters in, so the numbers are going to look very similar, and the most recent outperformers will have probably the best year to date numbers, although that keeps changing. But EMX Asia, developed markets, and then Asia Pacific ex Japan did actually very, very well. And so those are the key markets that have performed relatively well. And overall, between asset classes, equities have done well versus fixed income. But long term, as you can see, there's no rhyme or reason in these numbers. And as you saw, EMX Asia was one of the worst performing throughout the past decade, excluding the most recent upturn. So it's very difficult to forecast and predict markets. Okay, so we're going to touch a little bit on the macro. As you know, the macro has improved and growth rates have accelerated across the globe as the COVID-19 pandemic has started easing. Increased vaccinations, despite the Delta variant picking up, has caused less of a disruption in economic activities. The global manufacturing and services PMI, which is a leading indicator of future growth, has rebounded very strongly. And in particular, as activities and human interaction and shops have opened up in mostly developed markets where vaccinations have been high, services has continued to power ahead as a very strong recovery has taken place. If you look at the manufacturing PMI breakdown, you can see that the developed markets now are returning to levels which are, well above. So 50 and above are growth rate levels, and below 50 is contraction levels. And so we're approaching above 60 as an index number, which is quite robust as a growth index. But you can see that we are seeing a little bit of a wobble in the emerging markets, especially in Asia and in countries where vaccinations have not been as high. So obviously India, after doing quite well towards the end of last year, coming into this year with the Delta variant, has been struggling, as has Russia and Mexico. So growth is quite robust, and what that's resulting in is inflation starting to pick up again. And the base effect is the first thing that impacts us. So if you had a very low inflationary environment, or disinflationary or deflationary, outright deflation as a base, then 12 months on, because this is a year-on-year 12-month number, the numbers are going to jump, right? So that's just the base effect of both growth and inflation. So as you can see, the blue is cold, red is hot. So blue is below trend inflation, and we can see that last year, first and into the second quarter, third quarter especially, you see really dark blue lines. And as we enter the year-on-year base effect of April and May in the second quarter, you can see that inflation now is running hot in many of these countries. Obviously, we will talk more about inflation in another session, but we also had a session with James recently where we talked about these macro issues. I think that the tail risks of inflation remaining stubbornly high may be rising. But at the same time, the base case scenario for inflation is still that there's long-term secular disinflationary forces that we are fighting against. And so the base effect will pass. That's the transitory portion of inflation. The supply constraints that leads to cost push inflation. And one of the main reasons why a lot of asset classes, including commodities and services and manufacturing, semiconductors, etc., we've had major supply bottlenecks. And as a result, we've seen, cost push inflation feeding through in the economy and leading to increased inflationary pressures. And so those things may start to ease as well. But I think there is concerns about the monetary effect of inflation, which is not going to be taken away immediately or in a big way. And therefore, it's something that we need to watch out for. So inflation is something that we keep very close track of, because it has a major effect on interest rates, which has a major effect on fixed income. But in a muted, positive, or slightly high inflationary environment, equities and real assets actually do quite well. And so equities is quite well placed, I think, still versus other asset classes. Okay, so on equities specifically, if we look at the breakdown of returns across large and small in terms of the factors, and then value and growth, and then profitability. And the reason we do this is because obviously we have dimensional funds, which is a wonderful systematic quant fund. The difference with other smart beta or quant products is that they don't specifically expose themselves only in these factors. So they don't buy just small cap. They don't just buy value stocks. They don't buy just high profitability stocks. They buy the broad market. So the globally diversified dimensional funds like World Equity or Global Core would own everything, but they will tilt the portfolio towards these proven factors of return. So they actually have exposure to the broad market, and broader than most active indexes, like the MSCI All Country World Index. So if you look at the all country market returns and you break it down, then obviously in the second quarter, and I'll show the year-to-date numbers later, second quarter, we had large caps and growth large caps outperforming everything else. That's the first thing. But we have seen high profitability coming back quite strongly across the board, whether it's large or small. So this is the kind of the factor breakdown of the equity market performance during the second quarter. If you look at it from a longer term perspective, then obviously Q2, you see the large growth outperforming, but year on year, 1 year on, the numbers look quite different. So growth has largely been across the space, small, mid, large. But if you look at the value breakdown, you can clearly see that large value underperformed versus small value, which has had a massive outperformance. So SMID, as we call it, small and mid cap, SMID has done really well in value, and the blend has done quite well. So across the board, value has outperformed growth, but it's been largely driven by mid and small caps. But over a 3-year, 5-year, 10-year period, obviously we've had a tremendous decade for growth. Prior to that, the previous decade, we had an amazing period for value. So many people are saying the next decade is the decade of value, but we don't make predictions. We'll see. But it's interesting that this quarter we flopped a little bit before we flipped, and then we'll see how that we do in the next quarter. Top bottom equity performers as well. Obviously, commodities and energies had a roaring comeback this year, mostly in the first quarter. So they're starting to give back. And in the second quarter, it's much more interesting that it's actually both. So, commodities and technology, the traditional growth, did really well. But the other thing is real assets did, tremendously well. So it's not just commodities, but it's across real assets. So real assets meaning physical assets like real estate exposure and other asset classes. So it's interesting that real assets is coming back, and it's a much more broader recovery that we are seeing. At this point, I'll hand over to Wei Mei for the fixed income stuff.
Thanks a lot, Sam. Moving on to the fixed income asset class, one of the key trends that we've been seeing in Q2 would be the curve flattening. So what you would witness in the red line would be where the current yield curve would be at the end of Q2. And 3 months ago, at the end of Q1, would be the orange line. And what you would observe is that at the longer maturity, particularly from 7, 10 to 20 and 30 year, you will see that the yield or rates have declined, whereas at the front end, it has remained relatively anchored. So overall, what you're seeing here is that for Q2, managers who have been able to maintain a long duration in a portfolio would have benefited, just simply because as rates decline, bond prices will increase. So the longer your durations, the better your outperformance. So I think this would be one of the takeaways. And I think this is a reversal of what happened in Q1. Because if you recall, earlier on in the year, there was consistently a lot of fear around the need to go shorter duration, simply because we were seeing 10-year yields going up. And Q2, the converse happened. So I think it's always difficult to predict where the yield curve is going to be, but we can dwell a bit more on where the Fed is heading later on as we go through the outlook. So on to the next page. I wanted to share with you the different subsectors within fixed income and how they have performed in the second quarter. The key takeaway here is that credit has outperformed sovereigns, and you can see that government bonds in general would have been underperforming. The box that I've highlighted here will show you DM government. So that is developed market government bonds. And that's the gray box there right at the bottom for the year-to-date number. And clearly, I think where we have seen the outperformance would be in credit sector. That could come from high yield. And in both US, Asia, as well as Europe, year-to-date, higher bonds have done extremely well. Investors are chasing for yield. And we are clearly seeing also default rates are declining. The overall credit fundamentals have improved as we move towards more of a mid-cycle recovery. And I would also emphasize that for investors who are looking for valuation, the emerging market would be a subsector that had previously been underperforming. So it looks relatively cheap. And I think that gap has started to close. And in Q2, you are seeing emerging markets doing a lot better. And that sector has also rallied, which is why overall, whether you're being exposed to emerging market bonds, high yield, investment grade, those would be the sectors that would have come up tops. Moving on to the next page. In terms of Sing dollar return, which I think will matter most to most of you, We are looking at absolute return of about 1% for the quarter, and I'm using the Barclays Global Aggregate Bond Index as a proxy for broad market returns. Across the board, it will be interesting to also see that if you move down the credit curve, meaning that you're taking on more risk and moving from AAA rated down to BBs, you would have seen more returns, and clearly those would be sectors that have outperformed. The other trend that you see will be in terms of maturity. If you are going longer maturity, beyond, let's say, 5 years, you're going to be reaping more returns compared to if you had stayed short duration. So that goes back to my earlier point, because we have seen interest rates coming down, especially on the long end of the curve, during the course of Q2. On to the next page. And I see Sam has actually changed to the Endowus t-shirt. Wow,
Yes.
that's very fun.
Somebody pointed out that I should be changing to the Endowus, but I can't even show it. Like, my brand is. So guys, yeah, if you want one of these, please visit this Endowus Singapore office and ask for one. Post P2. Next slide, right?
Yes. Many of our investors have been sharing with me that they do want to see income in their portfolio, and I want to reiterate that income remains a very important component when it comes to total return. Simply because as we anticipate overall a rising inflationary environment and also rising interest rates, what's going to happen here is that higher coupon bonds are going to be more defensive and more sought after. So in essence, even if you're expecting that from a price return perspective, that might be negative, the income component is going to be highly positive. And what I'm showing here is over the course of the last 12 months. Like what I shared earlier, the credit sectors would have outperformed, and income, which is in blue, it's still a good proportion of your total return. And I think this is where it will be important for you to think about continuing to allocate to fixed income as an asset class. And I think we still have a lot of room to be generating good returns just through coupons, because we are expecting credit fundamentals to remain strong. And if you're looking at local currencies, you could certainly gain some exposure with local emerging markets, both on the credit side as well as with sovereigns. And we are generally expecting that US dollar could be still declining and emerging market currencies could strengthen. So there is certainly also opportunities there, just capturing the currency component. And this is how you look at fixed income overall. It will be made up of 3 different areas that you can be generating return. On to the next page. I want to talk a little bit more about valuations, because you will read in the press that certainly in Q2, spreads have compressed because there is a lot more demand for credit overall. And the way you look at this chart would be to look at where is the 10-year average, and that's the light blue number. And I also want to point you to the dark blue number, which is at the end of Q2, where spreads are right now across the different subsectors. Pretty much across the board, the consensus here is that spreads are trading below the 10-year average. And for some of the subsectors, you would be also close to the historical tight level. And the range here is between the 2020 minimum as well as the maximum that you can see in orange and also green. So there is that full spectrum. 2020 was, of course, an exceptional year where spreads blew up right after the COVID crisis started, but subsequently recovered very strongly and tightened back in. So as a consequence, you see that huge disparity. But having said that, right now we are at a juncture where across most of the sector, with the exception of Asian high yield, you might find it relatively tight. But I have to admit that this number is as of end of June. across the first couple of weeks of July, we have seen spreads starting to widen out a little bit. So it's actually going to be a good opportunity to also add on credit exposure at this juncture. Okay, looking at the next page, I want to just look at the opportunity set. So for Q2, you realize that yes, across the board, spreads have tightened in. But like I mentioned, Asian higher and Asian investment grade are still areas in which you can find good value. And the numbers here do show you what kind of yield levels that you're looking at. I think the other question is also about investor expectations. If you're looking for a very high level of a yield that you can be getting in the portfolio today, clearly you do need to take some credit risk. And within the Asian high yield space, we're looking at about 6% year to maturity, whereas in investment grade, you're looking at only about 2.8%. So there is going to be quite a big difference, but it is still going to be better than the US or Europe at this juncture. Just don't look for return numbers that are in the range of 8 to 10%. That's going to be really hard to obtain unless you are going into China higher, or you're looking at some of the Indonesian credits, you can. But by and large, I would say that if you are trying to have a more diversified exposure, the numbers that you're seeing here will be a good proxy because they are referring to a broadly diversified benchmark for both high yield as well as investment grade. So at this juncture, I'm going to hand back over to Sam, where he's going to share with you the performance of our portfolios for Q2.
Okay, great, guys. Just before I do, there was a question that somebody asked, and I wanted to address it because I think there was a little bit of a confusion on this. So the question in Slido was asking, so if I buy on Dollardex, does it have to be, the rebate has to be bigger than 60 basis points to be cheaper? So in the case of this specific fund, PIMCO Income Fund, Poems and Fund Supermart and Dollardex would offer the exact same Class E fund, which is a fund level fee of 1.45%. Obviously, Poems and Dollardex, unlike Fund Supermart, so Poems and Dollardex is cheaper than Fund Supermart because they don't charge this 0.2% access fee or platform fee, or the 0.35% that Fund Supermart charges for equities. So I think that it's important to understand that if you combine both the fees at Endowus, it's still going to be cheaper than buying a fund without any access platform fees on Dollardex and Poems, because you're paying 1.45%. What you don't know is that PIMCO will be paying Dollardex and Poems half of this. So, like 65, 75, 0.6 or 7% from PIMCO goes to Dollardex and Poems. Half of this, right? So, the 0.6% that we charge is less than what Dollardex and Poems actually makes from selling this one fund. And the total cost that the client pays is 0.3% higher, even though, you feel like there's a higher cost to investing through Endowus. If it's a retail fund, it's simpler, right? Because it's a retail fund is the same fee level. If it's 0.6% and is the rebate, and 0.6% is our fee, then it's the same. So whatever fee category you're paying, whether it's CPF or SRS, which is 0.4%, or whether it's 0.6 to 0.25% for cash, that is what you need to look at in the investment list. So I'll clarify this in a further webinar where we'll go into a bit more detail about FundSmart and how you utilize that. The other question that was up there was about S&P 500 and how it's done well, and how we can actually maybe build a portfolio of only S&P 500. You can actually do that on the Endowus platform. You go to FundSmart, which is our fund platform, where we curate the best-in-class funds and only put them on. Unlike Fund Supermart or these other guys where you have 2,000 funds to choose from, you have already a pre-selected funds that Waymay, myself, and the investment office screens, does a lot of due diligence on, and then we figure out which is the best fund. So you don't have to go out and choose from 20 different funds. We choose the best ones out there and then put it on there. So in Singapore, the cheapest way to access a Sing dollar denominated S&P 500 fund. So I'm saying Sing dollars. So you can access US dollars. You can even buy UCITS ETFs, but it's all in USD. So we solve the Sing dollar for you. And also we put it into CPF. So with CPF OA money, the only fund you can buy is the Endowus Infinity S&P 500. So which is the Infinity US equities. So you can go into the Endowus Fund Smart platform and buy a single fund and access it through the Endowus platform. And for CPF, obviously, as the first and only digital advisor, and because we still rebate 100% of the trailer fees, that S&P 500 fund on CPF is exclusively available only on the Endowus platform. So please go to the endowus.com website, check it out, the details if you're not familiar with us. Look at the investment list and look at the funds available, compare the prices. For S&P 500, you could buy that for CPF or cash or SRS, and you can access that in Sing dollars, which is really important to match your currency exposure. So I'm going to go back to the performance. So this is the cash SRS core advised portfolios. As you know, this is made up of passive, broadly diversified portfolio of multiple funds that give you exposure to developed markets, emerging markets, for fixed income and equities. So the 100-0 is 100% equity and 0 fixed income. And then everything else is balanced, a mixture of two. So it's a multi-asset portfolio. And then the very conservative 0 is 0 equities and 100% fixed income. So if you look at it, you can actually see that it's been a very steady gradation of returns, whether it's in the short term or in the long term. When markets fall, like in 2018, you can see that equities actually, because it's higher volatility, would also fall more than fixed income. But obviously, in the first 2 quarters, you've had equities doing really well. And so year-to-date numbers are very positive for 100% equity, whereas fixed income had a terrible first quarter and then really rebounded quite strongly in the second quarter because we have high-quality PIMCO and dimensional fixed income core products in there for emerging markets, developed markets, sovereigns, as well as corporates, and some exposure to mortgage-backed securities and high yield as well. It gives us a very diversified exposure by sector and geography. So what we do is build a strategic passive asset allocation. And this is really important because I see a lot of questions about us comparing with other robos. And I actually have some slides on the performance of us versus other robos that has been in the public domain, that has been shared quite widely. So it's okay to talk about. And I'll tell you why Endowus is the best performing robo and the best performing digital wealth platform. So when we compare the performance against index, the other thing we have to remember, and we're transparent with all our numbers. We give you as much numbers as possible on the platform, on these webinars, on our insights article. So we have an insights article that's come out today on the second quarter performance with much more details and charts. A lot of the charts in the webinar slides is also in there as well. So please check that out on the endowus.com insights webpage. But when we compare it to benchmark, we have to understand that the benchmark doesn't have any cost embedded in it. But if you want to invest, there is a cost, whether it's a brokerage cost, custody cost, or I showed you all the trailer fees and embedded cost of accessing a fund. So we take out all the fund level fees from the return numbers. So it's not an apples to apples comparison because index is something that you cannot actually generate. There's always a cost, even if it's a very small, very large ETF with a very low cost, it's still going to be index minus cost. So you cannot be apples to apples. But what Endowus has done is created a strategic passive allocation portfolio, giving you global diversification, giving you sectoral diversification, and brought it to you at really low cost. So even if you embed the cost into it, it's tracking the index really well with very low volatility. And especially the fixed income portfolio has continued to track or beat the index consistently year in, year out. So the cash SRS portfolios have done quite well. And year to date, the equities portfolio is up 15.7%. And you can look at the various factors, because dimensional gives you exposure to proven factors of return, like small, value, and profitability. And all of those three segments have year-to-date done quite well. So you can see that small has outperformed large year-to-date. You can see that relative price, small value has done much, much better than large growth. And then the third one is profitability has beaten low profitability for the small cap. But there's one anomaly, which is that high profitability in large caps has actually done poorly. So once again, value seems to be the key driver of returns year to date, especially in the first quarter, although they've given some of that back. That's developed markets. This is emerging markets, and it paints a very similar picture. Every other thing stays the same in terms. The magnitude obviously changes. Small value has massively outperformed large growth, but again, profitability in small caps has done really well versus low profitability. But again, large, high profitability has underperformed low profitability. And this is normal in a recovery, cyclical recovery. So we talk about how the junk recovers, right? And, commodities recover. So these sectors, which are low quality and low profitability, actually often outperform over a short period of time before quality and profitability returns as factors that will dominate returns over the long term. I'm going to hand over to Wei Mei for the fixed income part for the year-to-date performance breakdown.
Yeah, so on the fixed income side, in terms of returns, effectively for the first half of the year, you're still going to be having slightly negative returns. And reason that is because the first quarter decline was much larger than the recovery in the second quarter. So net is still going to be negative. But having said that, second quarter, you have clawed back some of the potential negative performance, because we have seen that overall for our portfolio, it was relatively long duration. And there was also exposure to government bonds. So second quarter, it certainly did better. But having said that, I would also emphasize that in terms of stronger returns, it has got to come from credit. And essentially for the cash and SRS portfolios, it would have done very well on the fixed income side, because you do have larger credit exposure. But for the CPF portfolios, in general, most of the funds would not have high yield. And as a consequence there, you would be trailing behind slightly. But I think the key thing is always to remain more diversified, because it will be important. No one really knows which directions interest rates are going to go. And as much as I think the consensus trade in the first quarter was going in short duration, suddenly you saw that government bond yields decline in Q2, right? So the Fed has also been making surprising moves, with the June FOMC being the turning point. And now we are having more discussions around the potential Fed tapering, which could happen in August and September. So I think it's anybody's guess where markets are heading, but at least for Q2. I think it's important for you to understand that we have clawed back some of the performance that we suffered in Q1. And overall, I think fixed income still continues to have a very strong place within the portfolio context.
Great. Thank you, Wei Mei. And I'm going to move on to CPF core advised portfolios. Obviously, we have a different mix of funds available in the CPF investment scheme. And so we don't have PIMCO, for example. We don't have Dimensional, unfortunately. There was a question in the Slido asking, when is Dimensional coming to CPF? Again, we apologize, but we've been working really, really hard to get Dimensional funds onto the CPF platform. We are almost there, and so we are hoping that the good news will come very soon. But when it does, you will be the first to know. So please let us know. Reach out to support@endowus.com with many of these questions that are about performance, how it's shown, questions about when is Dimensional coming. then this is all anonymous, so I don't know who it is asking this question, but if you reach out to our support and client experience team, they can keep you on a tab, and then we'll let you know as soon as the funds are available, so that you're the first to go into it. So those are not available in CPF, but what's available is 2 wonderful Vanguard passive index funds, the only exclusively available index funds, low cost. Endowus is the low cost way to invest there in CPF as well. So this portfolio has done relatively well again in second quarter. So the 100% equity, strangely, did exactly the same as the cash SRS portfolio, so 6.7% during the second quarter. The fixed income actually did slightly less, but returned to positive ways. So the year-to-date numbers, which lagged in the first quarter because it doesn't have dimensional, is actually up to 13.2%. So pretty good numbers. And then fixed income is now positive in the second quarter. And I'm going to move on to ESG, because as you guys all know, I'm a very big believer and proponent of ESG, sustainable investing. We've had tremendous performance in 2019 and 20 because, maybe impact of COVID, especially last year. And there's a natural bias towards, technology and growth stocks in this segment. But having said that, we have a broadly diversified ESG portfolio, which can be considered a core allocation. So for me personally, I allocate at least 30% of my total investments in Endowus platform to the ESG portfolios. And many other people are doing so as well. In fact, in the second quarter, after a bit of a lull in the first quarter, where it underperformed the other portfolios, in the second quarter, the ESG portfolios actually did the best. So it rebounded quite sharply with a 6.9% almost return versus a 6.7% for cash, SRS, and CPF. So the numbers are improving, and year to date, we've got pretty good double-digit returns, which if we can sustain would compound our returns and our wealth really tremendously. And in fact, the fixed income portfolio actually did in between the cash and CPF 0.9 kind of return, again, positive again, and continue to perform well into the third quarter. So hopefully ESG portfolios for both the fixed income and equities will deliver good returns this year. There was a question in YouTube actually from Dennis Lee asking how do we compare with Money Owl's dimensional portfolio. So you can create those Money Owl performance Money Owl performance on the Endowus platform. So FundSmart allows you to build the portfolio. Just like, why a lot of people don't like using Roboadvisors that use US ETFs. Some other person asked that question. But, people don't like to use it because there's 30% withholding tax. And there's a huge FX cost. And I think, one of the platforms, Stashaway, charges you fees on the FX conversion, which is ridiculous, I feel. But anyway, the bottom line here is that there's a lot of hidden cost in the robo-advisors themselves, like the taxes and the FX cost. And also, the level of fund level fees, because they're active managers and they keep buying stuff like China Internet or stuff that are very expensive. I think the China Internet ETF costs 79 basis points, 0.79%, which is more expensive than any of our equity portfolios, for example. So there are like embedded costs that are much higher. And so ETF is not the best thing. It is wonderful, but there's no local SGD denominated ETFs. And the better and more tax efficient ETFs to use are the Irish domiciled UCITS ETFs. And it's very, difficult to buy them, and it's quite costly at the fund level versus the US ETFs. But, I think it's still better. But the question was, again, how do we perform against other robos and Money Owl included? Obviously, in the first quarter, dimensional funds did well. That's why cash SRS portfolio from Endowus also did better. But as you can see, the second quarter, I think there's been a little bit of a rebalancing where, traditional passive index funds have done better as well. So as a result, in the second quarter, Endowus has outperformed dimensional portfolios from Money Owl. And Money Owl also has to be honest, the fixed income is not very global or diversified. They use the short duration only. So it's a little bit safer, but over the long term, it doesn't provide you with the returns or the diversification, a proper diversified fixed income portfolio can give you. I'm going to wait until a little bit later for cash management. I'll come back to this. But this is a chart that Keith, a good friend of ours who runs the Investment Moats blog, posted earlier this year. So this was, I think, in April. You can see by comparison all the different SIFE portfolios, the REITs portfolio, which really tanked, and then the ARI, which didn't do anything, and then the growth portfolio, which also had a massive wobble in the year. All of them underperforming, as well as the Stashaway portfolio. The only ones that track the index. So the index is index is the green line. I can't see very well because of the thing. I think it's the green line. And the index, the only robo who tracked the index was actually Endowus. So it has the highest tracking. And at the end of April, year to date, we were exactly in line with the index. So dimensional did slightly better. As I mentioned, in the first quarter, the factors of returns actually did well, value and small. But in the second quarter, what happened is that Moneyal underperformed. Endowus continued to track the index, and everybody else did quite poorly, continues to do quite poorly. And how do we know that? We know that because our friend who is part of the 1M65 movement posted his returns on a monthly basis and year to date for the exact same 100% equity portfolio. So this is excluding fixed income. And fixed income, everybody knows Endowus has the best portfolio and the best performing. But equities are the one that everybody keeps asking. So equities, you see the numbers in plain sight. We don't have access to this data, but this is what an actual client has posted for the exact same 100% equity, highest risk portfolio for all three major platforms. Moneyal doesn't exist, but we can replicate that with the dimensional funds because it's transparently available. And we know that we've done better than that. SIFE actually did a little bit better in the second quarter, but obviously Endowus portfolios outperformed every single fund portfolio out there. And obviously it did much better than the actively managed Stashaway. I think they recently had another what they call reoptimization, where they shifted asset allocation dramatically. So I think they cut some weights and then moved things around quite dramatically. And that's a very active asset allocation. So answering one of the questions in the Slido about why we were able to outperform. It's not that we outperformed the other robos, it's that the other robos underperformed quite badly versus passive index investing strategies. And there are various reasons. If you're more active, you underperformed even more. And so that's basically the bottom line. We're a strategically passive asset allocator. So we try to be globally diversified. We lower cost. So we are the lowest cost platform versus these other robos. Especially if you include the tax cost and if you include the FX cost, is even more. So I think somebody, another blogger, calculated that Stashaway total cost is as high as 2%, which is even higher than most unit trusts, even though they use ETFs because they have multiple layers of fees. So I'm just sharing a lot of information that's very public. So it's not us bashing other robos, it's just transparently what the performance is. And what I get really upset about is that Endowus publishes all of these portfolios. And the reason I can't answer that Moneyal question or any other question is because I can't see the numbers on their website. You can see our numbers updated monthly, even before you even sign up for Endowus, before you invest with us. You can see the numbers, you can see what the underlying portfolio is. So we're fully transparent about every layer of cost so that you see everything before you start investing. And after you invest, you can continue to see all the costs transparently. So final piece is not in the Insights article, it's the cash management and the defensive portfolios. So giving you an update on the returns. Obviously, it tracks kind of the level of risk that you're exposing yourself towards. So the core is the lowest risk portfolio. Enhanced mixes a little bit of short duration fixed income to get you a little bit higher returns. Ultra gives you even more exposure, but because we use multiple funds to lower the correlation, the volatility is actually much less. So if one fund underperforms, it's offset by other funds that have low correlation. And then the ultra defensive portfolio obviously in the second quarter actually did really well because short duration performed quite well. And this compares with the 100% fixed income performance. So the gradation of risk is kind of like convex shape. So the shortest, like the lowest risk, is going to just give you steady low returns. And even when markets fall, like it did this year in fixed income, it's not going to fall. The middle part will actually do the best during this kind of volatile period, and the 100% fixed income will obviously do the worst because it has a higher volatility. It's exposed to longer duration, and therefore mark-to-market losses will appear. But obviously, because your investment horizon is longer, even the 100% fixed income will eventually come back to a positive return. And our numbers show that it rarely underperforms or it shows a negative performance beyond 12, 18 months. And I'll show you in a chart what this looks like. So the three cash smart portfolios obviously have short-term volatility if the more you're exposed to fixed income versus purely a cash fund or a money market fund. So as you can see, the cash smart core has throughout this year been a very steady eddy return. And it, since the beginning of last year. So this is the COVID March correction that we saw, massive disruptions to fixed income, as big a disruption as 2008 for many sectors of fixed income. And yet Cash Smart Core just rode that through with a steady amortized return. Cash Smart Enhanced obviously had a little bit of volatility, but that number is less than 1%, or just around the 1 point something percent peak to trough fall. And it was very short and it quickly recovered. And Cash Smart Ultra obviously is a little bit more volatile. And again, in March, April of this year, when interest rates rose and fixed income markets came back, you saw that slight volatility in Enhanced, but quickly coming back, and Ultra showing more volatility. But the interesting thing is that this is actually just a 98 to 104, 105 index. So what does it look like if we compare to the ultra defensive portfolio and the 100% fixed income portfolio? So you can see that the three blue lines now look like it didn't move that much because that level of volatility is very, very low. And the ultra defensive portfolio did what it was supposed to do because the ultra defensive portfolio is a 100% fixed income portfolio. So it sits between Cash Smart Ultra and the 100% fixed income. So it was more defensive than the 100% fixed income, and it rebounded faster. But then obviously, as 100% fixed income continued to rally, 100% fixed income overtook ultra defensive portfolio. And if you look at it from the bottom of March, the 100% fixed income portfolio generated tremendous returns that was above and beyond the index returns. So this gradation of risk, as we always say, risk and return are always correlated. So it's really important for us to assess the two. So this is a chart that we will share with investors, and it did exactly what it was supposed to do. Now, for the Q3 outlook, I'm going to hand over to Wei Mei.
Right, thanks a lot, Sam. So we're almost near to the hour, and I'll try my best to go a little bit faster so we have some time for Q&A. But first of all, as we get into the third quarter, I think it's important to review what would be the outlook. And if you just look at the speedometers here, I think it's a quick way to assess where we are right now. For economic activity, I think we feel that overall we are still going to see a pretty strong trend as we move into a mid-cycle recovery. And generally, we still expect that both fiscal and monetary policy will remain supportive, and output will continue to grow. So you should still be seeing improvement in both services as well as manufacturing PMIs. On inflation, I think this is the top of mind question on where we are right now. So while we are seeing some of the short-term pressure coming from supply chain dislocation, and also in terms of, let's say, wages and commodities pushing up prices, we do anticipate that this continues to be transitory and it's going to be more of a temporary phenomenon. And while we may see some uptake over the course of the next couple of months, it's still not going to be cause for concern, especially for the Fed, who is having inflation targeting framework. We are nowhere near close to that 2% that they are monitoring. And I think overall, we should still anticipate that from a monetary policy standpoint, it's still going to be relatively easy. At this juncture, we are seeing that the markets will be pricing in 2 rate hikes in 2023, and that will amount to about 50 basis points. And in China, on 15th of July, we have also seen a 50 basis point reserve requirement ratio cut, which I think continues to provide a good comfort level for investors across most of the major economies, be it ECB, the PBOC, as well as the Fed. I think there's generally going to be consensus that rates will remain low. But given that we have got other regulatory activity that's going on, and I know that there are some questions around China, which we can pick up a little bit later, we should anticipate that volatility will remain a key feature. And I think for investors, the key here is to make sure that you don't panic and you're not going to exit the market, because it's always about remaining in the market and the amount of time that you have to overall look for compounded returns. On to the next page. I want to touch on what are considered peer risks, because I get this question a lot. And I'm showing you a survey from 270 institutional fund managers. So these are effectively the smartest people that you have in the market today. They are the ones managing the biggest funds out there. And here's the consensus from the survey across both June as well as July. And you do see quite a bit of changes, right? June would be the light blue bar, and July is the dark blue. In June, most people will be talking about taper tantrum, and inflation would be consistently one of the biggest tier risks. But having said that, I think COVID-19 has come back again. It is increasing in terms of concern. So while it's still in the 5th position, across the summer months, we could also be expecting the Northern Hemisphere to be seeing an uptick when it comes to increasing cases of the Delta variant. So I think we should be prepared for that. And at the same time, there is always a possibility of a market sell-off if generally people are getting a lot more cautious again about potential lockdowns that will be happening in the developed markets. Asset bubbles have been one of the other key topics that have come up quite a fair bit around whether there is a possibility that central banks will cause a cutback on financing and credit, and therefore we could be seeing deleveraging, and potentially areas like real estate could suffer, and that's when we talk about asset bubble bursting. I think this is not a major concern, but having said that, it still made its way into the top 5. And with a China slowdown, I think this is more evident, particularly with the news that's happening this week. But again, we can go into a bit more detail about our views on China during Q&A. On to the next page. I want to emphasize that everyone's now talking about the COVID pandemic moving into an endemic situation. And we hear that in Singapore as well, with the government emphasizing that we have to live with the virus. And I think this is true across the board globally. And I'm showing you the chart on the left-hand side, which will indicate that we have a good number of countries that have got a large proportion of their population having received at least one dose of the vaccine. And in terms of number of cases on the right-hand side, you can see that you're now getting a longer tail, meaning that we have passed the peak in terms of the number of cases, but we are not going to totally eliminate COVID-19 as a form of tier risk, but rather you're going to see that there will always be some cases that will be happening in our environment, and we do have to live with it. which is why I think overall we would anticipate that the possibility of COVID-19 further affecting the broader recovery is going to be predominantly less pronounced compared to when we had these conversations in the earlier part of this year. Moving on, let's just take a look at what's going to be happening in terms of Fed announcements. There has been a lot of speculation in the market, obviously, on when tapering is going to happen. And people are talking about taper tantrum, which happened in 2013. And I've also had questions like, okay, what kind of tantrum is the Fed throwing? The key thing here about taper tantrum is the fact that you're anticipating the central bank redrawing a loose monetary policy, and in effect, you're going to see that interest rates will start to rise a lot quickly. And if that happens in a very sharp move, this is going to be called a taper tantrum. And 2013 was a good example. Question now is it going to happen across the next few months? 70% of the managers that were surveyed indicated that they are expecting at the upcoming FOMC in August and September, you could see that happening. And 39% thinks that it will be happening at the Jackson Hole Symposium, while there's another 31% thinking that it will be a little bit further down the road at the September FOMC. So there are obviously different views out there, but in total, I think vast majority thinks that before we get into Q4, some of these asset purchases are going to stop in the market, and we're going to see a little bit more restriction. So that's how it is in terms of the overall outlook. Moving on, I want to look at what are the asset classes that will outperform, because obviously the implications here would be what you should be doing for your respective portfolios. And if you are new to investing at this juncture, is it actually a good time? If you were to ask me where we are in our recovery cycle today, I'll point you to what I would deem as expansion mode, with the manufacturing PMI, which is the Purchasing Managers Index, in the greater than 50 range, and it's also rising. And that's exactly what we are observing today. In this environment here, you will see that the green bar, which would be equities, be it US emerging market or Asia, will all be having fairly strong performance. And for fixed income, which are the blue and purple bars here, they will also have positive return, even though it's going to be slightly lower compared to equities. US dollar will underperform, and gold will most likely also have positive returns. And this is based on data going back to 1998. So while we're not saying that this will again happen this time around, this is a good proxy of trying to anticipate what could happen. And I think there is still going to be a lot of room for majority of the asset classes to do well. And until we see that the economy is slowing down, then we should be anticipating looking at either a cooling or a contraction scenario, but we are clearly not there yet. So I think everyone should be quite consistent in terms of how they view expansion and how asset classes are doing. Let's look at the next page. The other key question that has been emphasized would be around whether fixed income still has got a place in the overall portfolio. So while equities in your previous slide looks as though they are going to be clearly the outperformer, I want to emphasize that it's important to look at correlations. And over here, this chart shows you the year to maturity of the different fixed income subsectors and their correlation with MSCI All Country World, which is a proxy for the equity markets. Even on the right-hand side, you will see that majority of the credit exposure could be investment grade, could be high yield. They don't have a one-to-one correlation with equities. So it means that if you add them to your portfolio, you're going to benefit from the diversification effect. And in essence, they are still going to help you also achieve a higher year to maturity compared to government bonds. Government bonds, on the other hand, are generally negatively correlated with the broad equity markets. And when that happens, it means that they are moving in opposite directions with a negative correlation. So it always means that it can act as an effective hedge to your portfolio. And while returns look to be very low, and in some cases they are obviously negative, especially the European countries and also Japan, there is a cost to hedging. So I think that would be important considerations for you as you think about the different fixed income allocation. And for us at Endowus, we do believe that it is always important to continue to have fixed income as you construct your portfolio. On to the next page, I want to share with you inflations and what's the implication for the different asset classes. I've been getting this question a lot over the last month. And I think where we are today would be in the lower chart, where we have low and rising US inflation. And you may disagree with me and you feel that, oh, no, it's going to be a high and rising US inflation. But let's just take a look at the levels today, right? We're nowhere close to the US average inflation of 1.9%. So it's going to be difficult to argue that we are in the top chart, but I've put it there just for your reference, just in case you do want to take a more skewed view as to where inflation is heading. So let's just assume that today, if we are expecting inflation to be transient and it's not going to be as high as what we have seen in the latest June number, what we are expecting now is, of course, for equities to do better. You're still going to see sectors like higher emerging market, real estate, and commodities to be doing fairly well. And I think the areas that will certainly do less well is going to be government bonds. And this is what has transpired from 1989 to 2020. So we have got a very long time frame here to see how asset classes would have performed during this period of time. And obviously, I think these are the key data points which you can take reference. And I think we do feel very comfortable that at this juncture, in terms of majority of the asset class as well as subsectors, we should still be expecting decent positive returns. And we would anticipate that it's also important that you are looking at it from a longer investment horizon, right? We're not going to look at it just from a quarterly basis. So these are data points which I think would be relevant, especially if you are concerned about what inflation can do to your asset allocation. And on to the next page, I just want to emphasize one point on duration. The other question that we should be looking at would be whether is it time to go short duration or should I maintain a longer duration in my portfolio? I think there are certain structural constraints depending on what sector you're allocating to within fixed income. For government bonds in general, if I'm just looking at 10-year treasuries or German bonds and JGBs as an example, duration is going to be about 9 years. So you're not going to find something very short duration except if you are going to buy 2 or 5-year treasury bonds, right? But obviously those returns would be almost close to zero or even negative if we're looking at JGBs. And if you look at high yield, I just want to share with you the part in green. Because higher as a sector, you can get a pretty decent year to maturity. And that sector by itself is always short duration. And you may want to ask me why that's the case. Structurally, that happens across the board because issuers who have got poorer credit fundamentals will only be able to attract investors if they issue shorter dated fixed income paper. And that's just the nature of the market. Whereas for investment grade, structurally it's going to be longer because these are companies with stronger credit fundamentals. They can borrow money for a longer period of time. And therefore, depending on what you allocate to, you do have certain skew. But having said that, I want to emphasize that at this juncture, if you're concerned about rising interest rates, certainly going slightly shorter durations will make sense. But you should also be looking for sectors that have got a higher yield, because that can cushion any downside in case there's mark-to-market volatility. Higher coupon bonds will always be the most sought after in an environment if we have got rising interest rates. So that would be the main thesis, and that's something that you should look out for. On the next page, let's just quickly run through what are the investor preferences that we have seen in the survey. And I wanted to bring up this slide because a lot of times we are influenced by tactical trades or ideas that have been circulating around, and that could be things like going long Bitcoin or going long tech stocks because you have got your favorite technology names that have been performing well. But this is certainly a very volatile way of investing. The trends in the market can change very quickly, and even across 2 months, you can see that commodities, which was previously the favorite in June, has not been a favorite in July. So nobody can really tell where this is going. And for sure, I wouldn't want to encourage investors to just look for the flavor of the month. And I think it's important to remain diversified, which brings me to the next slide. I want to re-emphasize that a portfolio that has got a mix of equity as well as fixed income will do better in the long run. And over the course of the last 20 years, you can see in the top chart here that the correlation between stocks as well as government bonds tends to be negative. So it will always be important that you have got both stocks as well as bonds in your portfolio. And when you allocate it, you will realize that your risk-adjusted return will look a lot better. And the number in the bottom chart just proves that point very clearly, that a 50-50 mix is always going to be better than just 100% equities or 100% bonds. And if we cannot emphasize this even more, I think the numbers here will show you that it pays to be invested for the longer term, and that diversification would still be the only free lunch that we can see when it comes to investing. So with that, I'm going to hand it back to Sam, who will take us through the Q&A.
Sounds good. So guys, we're already 18 minutes over the hour. So apologize. We tried to answer some questions in the middle. So, I think I'll do some quick fire question answering. Wei Mei, if you see anything that you want to answer, then yeah, we can please jump in at any time. But I'm going to go from the top. So we'll leave the first one out a little bit to the later one. But basically, I think there's a lot of questions about China stocks delisting and, what is the impact of the Endowus portfolio. And this is exactly why I think it's really important for us to be globally diversified, because we don't have a single geographic exposure. If you bought a China fund and that's it, you put all your life savings into it, then obviously you'd be suffering right now. If you bought a technology fund like in February and then you saw the March correction, then obviously you're going to be suffering. If you bought like, a geographic or a sector fund, or you bought gold last year and it did poorly throughout the last year, then, you're going to suffer. So global diversification, we show you the kilt charts of the multicolored charts for equities and fixed income, because diversification is something that really works. And so being truly diversified and not worrying about, which next flavor of the month to invest in is the right way to go. Having said that, obviously, Chinese stocks, this technology fund correction, we don't know how long it will last because it's an extraneous circumstance. Chinese government is what will dictate it. So anybody who tells you that they can predict what's going to happen in the future, you should try to avoid them as an investment advisor. So don't try to, predict the future. Have broad diversification. The other one that I wanted to ask, very simple question that people, sorry.
I'm sorry, maybe let me just quickly make a point on China in case we have investors who are heavily exposed to the China market right now or are looking for opportunities to add on. I just want to emphasize that for China, I think some of the regulatory scrutiny that's happening today is possibly long overdue. And if we speak to many of the fund managers that we collaborate with, I think that's the general consensus. If you look at China, they have got a slogan around preventing the disorderly expansion of capital. So you do know that they want to try and keep things under control, and so they want to ensure that there's also not going to be a huge exuberance that's going to be happening because of loose credit conditions. And the other thing that you should be focusing on would be from a policy standpoint, the government would be emphasizing common prosperity. And I think that's a key word. It's looking at social stability, and that would be the two key pillars. And with that in mind, I think the overall view that we would take, and of course, taking feedback from the managers that we partner with, is that we shouldn't be expecting something more systemic that would crash the market. But I think some of the headline risks in specific sectors are unavoidable. Previously, we had real estate. Now we have the edutech sector. And some areas like online delivery is also going to be under increasing scrutiny. But I think all this is going for the longer term stability that we should be getting out of China. And I want to say that the circular trend in terms of a strong growth that we should be getting from China itself has not changed. And if you're participating and getting exposure to the Chinese market, it's because you do believe in this circular trend happening.
Okay, great, Wei Mei. Just a couple of quick fire questions. One was, so do you have a fund that track NASDAQ? So you'd be glad to know we launched a bunch of tech funds that are now onboarded on FundSmart. So a lot of these funds have very high correlation with NASDAQ and technology. So please check that out. Also, there's a question about other portfolios SGD hedged. So all of our portfolios are in SGD. So you don't have to do any FX transactions in order to invest into the Endowus platform. But fixed income is what's XGD hedged. So fixed income, you're able to match duration and hedge the currency. So all of our fixed income funds are actually Sing dollar hedged, which is not provided by any other digital platform. Our equities funds largely are SGD denominated, not hedged. But once in a while, we have some funds which are hedged. Another question, a lot of questions about performance. If you can reach out to our support@endowus.com or reach out to our team, that would be really helpful since we're not, since we have a broad audience. And so it's much better to address questions that are for the broad audience. And I'm just going to touch on one more, and then Wei Mei, maybe one more from you. And I think we really should wrap up because it's been going on for a while. And I'm going to take the first one, which is many are calling out for a correction soon. What is your take on this? We've seen multiple corrections, and corrections are just normal. So more than a 10% correction is seen in, more than half the time. 50% of every year we see a correction of 10% or more. 1/3 of the time we see a correction of 20% or more. 5% or more is, we see in almost 90% of every year. So it's very commonplace to see these corrections. The more important thing is, are you a short-term investor or a long-term investor? If you're a short-term investor, short-term corrections are, a negative thing and you worry about these things. But as a long-term investor, especially in a diversified core portfolio, you should not be worrying about the short-term movements because these are volatility. It's an opportunity to add to your position and continue to be invested in the markets long-term because the returns will compound to give you better returns. So no one can predict these corrections and how long these corrections will be. Who could have predicted that COVID-19, the worst pandemic in the history, and we're still reeling from the consequences of it, would result in a 30% correction, which is normal in a major recession or major shock, but it would be over within a month. So we cannot even time these corrections, but we can't even predict how long they will last. But what we do know is that over the long term, markets continue to move in a forward upward trajectory. And that's what happened last year, that even though the market fell 30% from peak to trough, for the full year, we actually saw a double-digit positive return. And prior to that, we saw a 20% plus correction only 2 years ago, which was 2018, prior to that. So within 3 years, we had 2 years of massive correction. But look at what the market has done over the long term. So really focus on the long term, guys, and not try to predict what the market's going to happen in the future. We're human beings. We cannot predict the future, so don't try. Wei Mei, maybe take one last question, and then I think we really need to wrap up.
Yeah. So I think one last question that I want to address is whether we are taking off benchmark tactical bets or we're just trying to replicate the benchmark. I think for us, our investment philosophy is always about passive strategic asset allocation. So that would be the key in terms of constructing your portfolio. And there is no tactical overlay. We do not have tactical bets compared to other robos who may be trying to time the market for that matter. And also, it's not because we are benchmark hugging. At the end of the day, this is about your asset allocation, and it really depends on your risk tolerance, more so than looking at trying to hug a benchmark, right? I think you're looking at the longer term returns and what is going to drive the expected return and also the expected risk of the portfolio. It's setting your strategic asset allocation at the onset. If you are going to be more conservative, you'll be going for something like 80% fixed income, 20% equities. And that's where we are also projecting for you what would be expected return based on what we have observed historically. And that's how you should be looking at positioning it and also aligning that with what you think would be appropriate based on your own risk appetite.
Wonderful. There's a shout out to Madeline from our client experience team. I hope Madeline isn't the one that wrote that. But actually, there was one question that at the end that came in late, asking, from what Wei Mei has shared, is it safer or more advisable to have 60-40 portfolios and 100% equities due to the market condition in US inflation? And maybe I can just add to that suggestion. I mean, the reason Wei Mei mentioned that was because a lot of people say that the 60-40 portfolio is dead, or because you cannot generate yield, you should not have fixed income in your portfolio. And Wei Mei clearly stated that there is still a place for fixed income. It's still a place for balanced portfolios like 60-40 or 50-50, and they, over the long term, will continue to do well. But the reason some people have 100% and some other people have 60-40 is because of their risk appetite, or it's their horizon in which they're investing. If you're younger, then obviously you can take the volatility and invest in a much higher volatility 100% equity portfolio. As you age, you should take less risk and less volatility. But it's a very personal thing. And so Wei Mei and I would have different risk profiles. We'll have different needs in the future, different goals. And so, we'll have a different portfolio. So it really is meeting the needs of our clients. And that's what the Endowus.com platform is. It's a total wealth platform. We provide everything that a client needs, whether it's short-term cash management, whether it's core portfolios, whether it's satellite positions, investors who want to invest in ESG, for example, sustainable funds. We've made it available to everybody. So it's institutional type investing, it's private banking services made available to all retail investors. Instead of starting from $10 million at UBS, you're going to start with $1,000 at Endowus. So really excited to have this webinar. We're hitting 1 hour and 30 minutes, so we should really wrap it up. So thank you, Wei Mei. You're on again next week with 3 amazing speakers for an all-female session. So really, we're looking forward to that. And, really happy that Xin Yan from Janus Henderson, Chu Ting from BlackRock, and Su Fan from UOB Asset Management will be joining our Wei Mei for this session on real estate investment. It also includes real asset investment as well. So it's a very broad topic that covers a lot of the most exciting and hot topics that are out there right now. So wrapping up, thank you so much for joining us tonight. Wei Mei, last words and goodbye.
I'm looking forward to our session next week. So I do hope that everyone can join us live. It will be next Wednesday at 7 p.m. And for everyone who has been very patient with us for the last 90 minutes, thank you for your support. And I'm looking forward to seeing you guys again soon.
Thank you, guys. Have a wonderful evening.